So I'm Guillaume. I'm with Amy Caldoun from the Panoptic research team. You've probably seen us do some live streams over the past couple of weeks. We're trying to kind of onboard more people to Panoptic, show them a bit more closely how to trade options, how to be successful trading options. So a lot of it is through showing the interface, how it works. At the same time, we're trying to also dig a bit deeper and do what we call research bite, but do some internal research. And we publish this live here to discuss to help people get a better understanding of options trading. So everything that we say here is not financial advice. It's a research focused stream. So again, this is all using real data, but at the end of the day, it's all for research. And again, this is a normal disclosure. So we'll actually go over one research piece from Amy. Again, Amy, welcome. I don't know if people know you. Can you tell us a little bit more about yourself first before we dig deeper into the research?
Yes, so hey guys, I hope there's no noises, annoying noises back in the background. So I'm Amy Galloun. I'm a quant researcher here in Panoptic. So I do mainly it's like modelization, math modelization of financial instruments. I have a bachelor in mathematics and physics and master's in mathematics, applied math in finance mainly. So yeah, I think it's it's
Welcome.
enough.
So yes, thanks, Amy. So Amy joined us middle of last year. She's been working on a few research pieces. I'm gonna actually try to see. I'll share that link to the research piece that we'll cover. I'll share it for a little bit. Uh, what we're doing is going over that research piece that was published in November. Let me kind of copy this. The key point is that we're creating a new options market. It's actually a new way of looking at options. And whenever you trade options, the implied volatility, the IV, is crucially important. The IV is what drives the market. And if the IV is low versus high, there's different trades for this. And we started with now going through the biggest market, which is Deribit, and looking at their IV compared to what we have internally on Uniswap, on Panoptic, and how that kind of all loops together. So this was a very cool piece. Very, very happy with the results. So we'll have Amy here talk about it in slightly more details. It's again, we're academic, so it's a presentation format. We have the slides here, so bear with us. You can sit through it, and then we'll go over the results and maybe have a few back and forths at the end to go over that. So yeah, take it away, Amy.
Okay, thank you very much, Guillaume. Okay, so hi everyone again. So today I'll be discussing a comparative analysis of implied volatility between Deribit and Uniswap, two major layers in the crypto derivative space, especially now with Panoptic. So I would like to specify that this presentation is an introduction of our series about the implied vol, meaning that I'll be covering more or less not too complicated elements about this topic. And then perhaps we will increase the level each week or each 2 weeks, because since I'm alternating with my colleague Nathan, that you'll probably see next week. So yeah, we can go to the slide number 2. So let's start with the fundamentals. Implied volatility, or IV. So what is it and why does it matter? So IV is a crucial metric in options trading that reflects market expectations of future price volatility. It is generally used for option pricing, risk management, and also trading strategies. And looking at our slide, we have two distinct approaches to IV calculation. On the left, we see Deribit's method, or any centralized exchange really, which uses the traditional Black-Scholes model since it is a centralized exchange that relies on order book data. In this case, we derive the IV by equating the theoretical price of the option, of the Black-Scholes option, to its market price. And on the right, we have Uniswap's innovative approach formulated by our CEO, Guillaume Lambert, where IV is calculated using a formula that incorporates 3 elements, so the fee rate, the tick liquidity, and the volume. By the way, I'm sorry if there's like any noise in the background because I'm in the airport. My plane was delayed by 3 hours. So I'm trying to do my best here, so I'm really sorry. So that's for slide 2. We can go to slide 3. Thank you, Guillaume. So now let's explore the fundamental differences between these two approaches. So first, looking at the pricing, as we saw before, Deribit relies on a traditional Black-Scholes option pricing model, while Uniswap derives its IV from actual trading activity and fee income. Since the latter, so Uniswap have a very different structure of the market that is primarily based on pools and not on order book models. Besides, in terms of time horizon, Deribit's approach involves fixed expiration dates, which directly impacts IV calculations. And Uniswap, however, offers more flexibility due to the perpetual nature of depositions. Also, finally, regarding market impact, it's interesting to note that while Deribit's IV can be influenced by large option trades, Uniswap's IV emerge naturally from pool trading activity. Of course, these are just three elements that have like differences that I've selected. There's more to it, and I'm happy to dive into that at the end if anyone
Yeah.
is interested.
Let me also add some color. So what I find interesting and unique about Uniswap IV is that it's not driven by market makers, right? It's not a market maker trying to price an option the best they could. And if you have dozens of them competing, you reach a consensus. And if there's a mispricing, people can actually trade on it. So derivatives or order book or any order book based options protocol requires these sophisticated participants to come in and trade. Compared to this in Uniswap, it's decentralized. You don't have one participant deciding on the IV, but rather you have hundreds of participants, each trading, and these traders move the price around. And depending on the amount of trading that happens, they now guide the volatility. So the more trading there is, the more volatile the asset, the more returns you get as an options trader. So it's a drastic new way of looking at IV as well. It's decentralized. You offset all the work to traders, and these traders now will guide kind of the realized volatility and the implied volatility that comes out of that. So that's kind of the unique way. It's decentralized in trading, but also the quantities, the IV, the market itself is decentralized. And then I like this a lot.
Yes, exactly. So now let's look at a fascinating example involving the US 2024 election on November 5th. So on this slide, we're comparing Uniswap IV versus Deribit's Devolve for Ethereum. The left graph shows the raw values of IV, while the right shows normalized figures. So Devolve or Deribit Index Vol is like a 30-day implied volatility index that gives us market expectations of future volatility based on Deribit's option prices. And for better comparison, we've normalized these values to a 0-1 scale, which helps us better visualize the relative movements between the two exchanges. So here we notice how both metrics show increased volatility around key political events, so in this case around the 5th of November, though they capture kind of this uncertainty in slight different ways. One main thing that is that Deribit IV is higher than Uniswap IV on average. However, Uniswap Vol seems to go higher than the Deribit one during the spikes, as we can see. We can also notice that there are a lot of inefficiencies in Uniswap, while Deribit is more subdued, and this is due to many reasons. So unlike Deribit, Uniswap is known for its liquidity fragmentation. We know that liquidity in Uniswap is spread across multiple tick ranges, and therefore this fragmentation leads to less efficient price discovery, because each tick range essentially creates a micro market with its own supply and demand dynamics. Also, it is safe to say that Deribit attracts professional market makers, as Guillaume mentioned, who use sophisticated models, and these market makers actively do their best to maintain tight spreads and efficient prices, whereas Uniswap lack this professional market making element because of its automated market maker. So
If I may add, so the inefficiencies that you're seeing, and I'm trying to zoom in out. So what Deribit's billions of dollars of TVL Pat is somewhat tame compared to Uniswap, and it's just kind of two different markets. Because there's so much money in Deribit, you can assume that the IV is going to be much more stable, and because Uniswap doesn't have enough, the capital is not thinking in terms of options enough as of yet. I guess with Panoptic it's different. You see, there's a wildly fluctuating IV. It starts at about 30, it goes to 60, back down to 25. Even though it's very straight, I mean, stable in the Herbert wall, it's extremely volatile. IV on IV, volatile on the Uniswap world. So if you see this, you should think about market inefficiencies, but also arbitrage opportunities. There
Definitely.
is a lot of room for these inefficiencies to be kind of arbed out. And again, like new market, if you're the early participant, you can tap into this quite a bit more. But in that specific case, it's extremely visual. You see these huge swings from 26 to 115 within a few days because of the election is actually due to these inefficiencies in the Uniswap market. The Deribit one is fairly constant. We rescaled it, so there is some movement, and it's still fairly tame compared to Uniswap. So the the take home message is that we have different measures for IV, for Uniswap and Deribit, but because of these different measures, there's a huge amount of arbitrage opportunity that exists as well.
Yes, exactly. Um, all right, so we can move into the next slide. So another compelling example from January 2025. So here we're looking at the market reaction um, to DeepSeek's launch of the free like chatbot app. So DeepSeek R1, I think it's called. And we thought it would be interesting to show how both Uniswap and Deribit IV responded to this kind of major, I would say, major tech event. I think like what's particularly interesting is how this single event led to like an 18% drop in Nvidia share price, which kind of created a little bit of a ripple effect in the crypto market of the crypto market. So yeah, the normalized comparison on the right help us see how both platforms capture this market kind of uncertainty, though with like different intensities and durations. So we can see like around the 10th of January, like there's an increase in volatility for both of them, Uniswap and Deribit IV. I mean, at the end of the day, we can notice that there's like, on top of these events, we still have like ups and downs throughout the days and weeks, and we can play around like to identify the reasons behind it. But in this case, like the goal of this chart is to create kind of a bridge between CeFi and DeFi. So comparing them helps us both do many things, like kind of bridge the gap between expected and actual volatility in DeFi versus CeFi, evaluating institutional and retail influence on volatility, also evaluating liquidity conditions in both exchanges. So higher Uniswap IV can indicate, for instance, low liquidity debt, or higher Deribit IV could reflect kind of a risk-off sentiment. So yeah, I mean, comparing both can signal whether volatility is being driven by trading activities or like kind of risk aversion. Also, what mentioned something important that like Guillaume mentioned is identifying the arbitrage opportunities between both exchanges. So, for instance, if Uniswap IV is superior to Deribit IV, it suggests kind of on-chain traders are pricing in higher volatility, potentially making kind of Uniswap liquidity expensive relative to Deribit options. So yeah, this kind of discrepancies in IV might highlight kind of DeFi inefficiencies, just as we mentioned, that traders can exploit.
Exactly, and this is kind of the key part too. It's like in the beginning when Uniswap launched, it wasn't clear that the prices will follow what happens on Binance or centralized exchanges like Coinbase. But then the market stepped up, and whenever there's a change in price on Binance, you see the same kind of trade. That's an arb trade on Uniswap. So here, what we're trying to show as well is that even though it seems to be uh, a little bit yeah, there's a tiny peak here overall, even though the IV of Deribit is fairly constant. The Uniswap one is going wild. So that's also like if you think of yourselves in whatever January 2020, and as Uniswap was growing, there is again a cottage industry of arbitrageurs that could exist to arm out the inefficiencies, not be subjected to just uh, the LPs maybe kind of directionality, but rather the options nature of Uniswap as a way to kind of arm this. So that area where it's too high or too low are both prime for type of trades that will capitalize on that inefficiency. So same way that if it's too high on Uniswap, you sell. If it's too low, you buy, type of thing. And yeah,
Yes. I think I've said, if we can go back to the previous
yes,
slide, I think I said increase in the 10th. I meant on the 27th of January, not the 10th. Obviously, the 10th there's a decrease. That's something mixed the
yes,
two dates. Okay. Now moving to the last slide. So to wrap up our discussion, we can highlight like few key takeaways. So first, it is obvious that we have identified a clear arbitrage edge. So yeah, in fact, traders can potentially profit from IV mismatches I mean, we can give an example like shorting, for instance, shorting derivative options while going long on Panoptic, uh, for example. Second, this comparison really highlights the fundamental differences between CFI and DeFi options. So derivatives structured order book based approach versus Panoptic's innovative perpetual ORAC free, also options on Uniswap v3. And and however, even if we have these differences, it doesn't take away the fact that we are still using the same traditional metrics for pricing. So here in this case IV, we are still keeping these metrics and kind of moving them from TradFi to CFI to DeFi. So it's the same. They still have the same meanings, the same purpose for either pricing or modelization or even comparison. In fact, we did even more. And feel free to look into our deep dive blogs. So there's more to it. There's like anything related to correlations or even more statistical metrics that we've computed for the sake of comparison between these two exchanges. I think it's very beautiful because there's a lot of math, and, and I love math, so feel free to check that out. Finally, we've observed also an empirical correlation. Like according to the graphs, we can see that every time the derivative IV changes, then it's either follow up or we have kind of an instantaneous change between both derivative IV and Uniswap IV. And also we have seen a higher Uniswap IV during spikes, and that's primarily driven by liquidity depth and fee-based pricing mechanism that we've seen in the formula. So yeah, so these differences obviously they create interesting opportunities in the market.
exactly. Thanks very much, Amy. And this is kind of the take-home message of maybe that research bite. It's kind of inefficient, but if you have one foot in the options trading world and you understand what Ivy is and how it behaves, there's definitely kind of ways to profit out of that. So before we launched Panoptic, it was a bit difficult to capitalize on these inefficiencies. If you look carefully, even the election one, we weren't launched yet, but we were able to extract the IV of a Uniswap pool. So now we can trade on this. And what we observe is that even though it's mostly below what it should be, if you look in terms of Uniswap returns, the LPs get paid less, which is in the bad spot to be. So maybe you can buy options. If it's higher, meaning now the returns are oversized compared to what you have on Deribit, maybe you can sell more and can capitalize on that higher IV. So all of this will kind of be a ongoing narrative that we are presenting here at Panoptic. There is a lot of research involved in creating options and trading options, but it's not meant to be opaque and impossible for anyone that's on the retail side to trade as well. You can see these inefficiencies and capitalize on them without having hundreds of millions of dollars like you would need on Deribit. You can actually do it at a small scale, and this is where you edge it. You're more nimble, you're able to capitalize on this more. So thanks very much, Amy. This was great. Again, we
Thank you.
aim to do this every Tuesday. and keeping it around 20 minutes, which is what we have. But remember, we post this on our YouTube. It's also stored on Twitter's servers or X's servers. We'll try to kind of use this as people ask questions, we can refer to it. But overall, this was great. Again, we have Amy this week. Next week we'll have Nathan Burks, who's going to talk to us about gamma traps and the doom loop. This is also another phenomenon that's kind of related to TradFi, but that has a unique spin to it in the DeFi world and Uniswap world. So feel free to join next Tuesday. But overall, this was great. Thanks, Amy. Have a safe flight, and hopefully won't get
Thank you
eaten
very
too much
much.
more.
Thank you.
All right. So on this, I'll end the stream. If you have questions, DM me on Twitter, or Amy, or anyone from the Panoptic team. We're more than eager to help you understand Panoptic and options trading. And on that, again,